Another all-time high. The long-standing promise Pring Turner Capital Group makes to clients is our commitment to protect and grow your valuable assets. This past quarter once again demonstrates how we have delivered on that commitment. The typical long-term Pring Turner client, adjusting for withdrawals, achieved another all-time high in portfolio value. This new high achievement marks the 11th year of the past 13 years. Clients can make this claim. This is especially notable considering the treacherous time frame represented one of the worst periods for the stock markets in the last century. As we pointed out in our January newsletter, quote, entering 2012, investors will be buffeted by both positive and negative crosscurrents, end quote. This past quarter benefited handsomely from the positive crosscurrents, even more than we had anticipated, as stock market performance was quite strong. As the chart illustrates, we are pleased to report the typical portfolio reached new high levels, an accomplishment few individual investors or even professionals can claim. To say the last 13 years has been challenging may be a slight understatement, because the total return, that is including dividends, for the stock market has disappointed investors with one of the worst performances in American financial history. This extended, dismal period includes two devastating, more than 50% stock market declines, and raised havoc for most investors and especially retirees dependent on a stable portfolio and income to supplement living expenses. We are pleased to report clients who have been with us during this time frame have indeed seen their wealth protected and steadily earned positive returns while taking less risk. Even more, we are committed to do even better for you in the next decade. Let's talk about the business cycle outlook. This business cycle continues to make slow progress. The slow recovery is typical of economic expansions that developed after experiencing deep financial crises, such as the painful 2008-2009 financial meltdown. Decision makers everywhere are understandably cautious, which supports both good and bad scenarios. Good in that no unhealthy excesses have developed yet. Bad in that cautiousness restrains spending and new investments. The outcome? A labored economic recovery. Longer term, one reason we have for low expectations for this and future business cycle expansions relates to the link between employment and consumer spending. This link is important because consumer spending drives nearly 70% of the nation's business activity. And the American consumer still has concerns for their job security, and rightfully so, resulting in cautious spending for goods and services. The secular market or bear market theme we outlined in our Lost Decade article published in late 2009 can in part be explained by the continuing U.S. struggle to reverse the long-term structure of American job losses. Recent monthly employment statistics reflect historically weak job growth for this nearly 3-year-old economic expansion. Relatively weak job growth is only part of a bigger problem. Millions of jobs were lost during the 2007-2009 Great Recession that have not been recovered and will take years to mend. The civilian employment to population ratio, that is, the number of working Americans divided by the total eligible workforce, demonstrates the extent of the bigger problem. Since the end of the last recession, it is clear no net new jobs have been created relative to our growing population. Jobs are simply not being created fast enough to meaningfully lower the unemployment rate and bring those idle workers back into the labor force. The result is a continued subpar recovery that teeters between modest growth and slowdown. Eventually, a stronger employment environment will lead to higher consumer spending and a stronger economy. The virtuous cycle we would like to see take hold. But this more favorable environment is not yet evident. Jobs create dollars for consumer spending, and consumer spending is the economy's engine. It leads to economic growth. Let's turn to the financial market outlook. U.S. financial markets are benefiting from 1, a slow and steady improvement in a still fragile economy. 2, a strong Federal Reserve easing monetary conditions. And 3, the perception of being a safe haven from the European debt crises. These conditions should continue to support U.S. financial markets for the duration of this business cycle and contrasts with less promising performance in overseas financial exchanges. We believe the 3-year cyclical bull market for stocks is not finished, but it is getting a bit tired. After a 5-month rally, the stock market is entitled to take a short breather. Expect stocks to consolidate some of the recent gains and pull back in price over the next few weeks. However, our business cycle research shows evidence of continued, modest, yet positive economic momentum. This allows the stock market more upside potential as the year progresses. We will be searching and evaluating additional conservative growth and income ideas to purchase for you on weakness. Our goal is to see your portfolio achieve further new all-time high levels later this year. As mentioned earlier, our longer-term view remains that the U.S. stock market is still in a secular bear market and faces headwinds for a number of years to come. In fact, the Pring Turner team has completed a new investment book to be published by McGraw-Hill next month, entitled Investing in the Second Lost Decade. Our forthcoming book not only lays out the detailed case why investors should prepare for another lost decade, but also how investors can protect and even grow their assets during this continued difficult time. The investment principles, disciplines, and course of action we explain in the book are the same ones that have brought you safely and profitably through the last 13 very difficult investment years. We are working hard to develop even better tools to navigate the second lost decade and look forward with confidence to both the challenges and the opportunities in the years ahead. Thank you so much for your trust and the opportunity to help you. As always, please feel free to contact us should you have any questions.